Welcome back to the deep dive. If you're trading the market, you live by the signals, right? And today, oh boy, are we unpacking the loudest signal of the year.
And you mean the George Raymond Zage the third transaction?
Exactly. And the subsequent take private offer for Grindr that followed just days later.
Yeah.
For anyone who tracks insider activity, and let's be honest, we live for this stuff. This is just a textbook case. You've got informational advantage wrapped up in, well, a perfectly executed corporate finance play.
It really is something. I mean, you have a director, a controlling shareholder making his largest stock purchase in months, just, what, 2 weeks before announcing a premium bid?
It's wild.
So for us, this isn't just another M&A headline. It's a deep dive into asymmetry, right? Our goal here is to cut through the noise, the press releases, and give you the actionable context.
Yeah, what's really going on behind the scenes? We want to reveal the financial engineering and maybe more interestingly, the surprisingly urgent personal motivation behind this whole $3.5 billion bid. Our mission today, for you listening, is to move past the initial shock value and really focus on the mechanics. How does a trader see this? What are the signals?
And from a finance pro perspective, what are the valuation questions,
Right.
the governance issues? What was the real trigger for this deal happening now? And crucially, is that $18 offer actually fair?
Okay, let's nail down the timeline straight away because the numbers themselves are pretty staggering. We need to focus on October 9th, 2025.
Got it. That's the day Zage buys 1 million shares.
1 million shares for $13.15 million total. So 13.15 cents per share.
Okay, $13.15 on October 9th.
And then the big reveal comes just 2 weeks later, October 24th, 2025.
Right. Zage and his co-investor James Liu, they formally announced they're making an offer
To acquire all the outstanding shares they don't already own.
for $18 per share, cash.
$18. That gap, that 2-week window is just analytically fascinating, isn't it?
It's critical. That $18 offer, it represents a 51% premium over Grindr's closing price on October 10th.
Which was the day after Zage's big purchase.
Exactly. And for Zage himself, that $13.15 million investment he made on October 9th, it basically locked in a 37% return right there if or when the deal closes at $18.
That tight timing is, well, it's analytically troubling, let's say. It strongly suggests Zage had a very high degree of certainty about that offer coming down the pike.
You'd think so.
Okay, so let's unpack the pattern here. When we look at insider buying, right, we always check the history. Is this just a one-off trade or is it part of something bigger?
Yeah, exactly. Is it a sudden move or, is there a track record, a continuation of a pattern?
And with Zage, there absolutely is a long history of accumulation.
He's definitely not a newcomer here. This George Raymond Zage III, the Singapore-based former hedge fund star, he led the original investment into Grindr way back.
Right, and he's been its largest shareholder basically since the IPO in 2022 through that whole SPAC transaction mess.
Exactly. And over time, he's put, what, over $200 million into Grindr stock?
Yeah, through consistent open market purchases. Which, okay, that forms the cornerstone of his legal defense, doesn't it?
Totally.
Yeah.
Look, I'm not acting on specific material non-public information or MMPI. I'm just acting on my long-term conviction. I always buy.
But, I mean, conviction is one thing. Timing a $13.15 million investment just days before you announce a 51% premium acquisition offer, that feels, well, a little different.
It feels like something else entirely. The sheer size of that October 9th transaction makes it stand out.
1 million shares.
It was his single largest insider buy in recent months. This wasn't just routine topping up. This feels like, conviction amplified at a very, very strategic moment.
highly strategic.
Yeah.
So the purchase happens October 9th, then the proposal follows on the 24th.
And the offer details. It's $18 per share, cash, for all the outstanding common stock not already held by Zage and Liu's group.
Which values the whole company at, what, $3.5 billion?
Yep, $3.5 billion. And this is where, their private equity background really shows. They're negotiating from a position of absolute strength here.
Well, yeah, we know from our own M&A days, right? If you control over 60% of the stock,
You call the shots?
pretty much, they don't technically need a majority of the minority shareholder vote to eventually push through a squeeze out, even though, good governance usually demands it.
And they didn't just fluke the idea. They backed it up immediately. They secured highly confident letters for all the necessary debt and equity financing.
So this wasn't some tentative feeler. This was a we are ready to go proposal.
Absolutely ready to close. But what throws a wrench in the works here, analytically speaking, is the contrast. the difference in what the insiders were doing right around that key date.
Ah, right. While Zage was dropping $13 million into the stock on October 9th.
His co-investor, the chairman of the board no less, James Liu, he was pulling $3.3 million out.
That's the infamous Lou factor, isn't it? Just 8 days after Zage's massive buy on October 17th, Lou sells 250,000 shares.
At around $13.20 per share.
So just above Zage's purchase price. This just messes up that clean narrative of unified conviction, doesn't it?
It really does.
Yeah.
I mean, think about it. If they're partners in this bid, why is one guy buying aggressively at $13.15?
And the other guy is selling at $13.20.
Only for both of them to turn around a week later and say, actually, we think it's worth $18.
Yeah. That sale means Lou was effectively cashing out at a price 36% below their own eventual offer price. It doesn't quite add up on the surface.
So you have to speculate a bit, based on the filings. Was Lou's sale maybe also forced? Did he have his own liquidity issues separate from Zage?
Was it tactical?
Exactly. Was it a deliberate move? Lou's sale helps establish a really low baseline price for the stock right before the takeover offer drops.
Interesting point. If the controlling shareholders are seen selling, even a bit, it can depress the price. It reinforces the idea that maybe $18 really is a generous offer compared to where insiders themselves were recently trading.
Precisely. If Lou's sale was just about needing cash, maybe it shows a lack of coordination in a really high-stakes leveraged situation.
But if it was strategic?
Then it's quite a performance, isn't it? One director loads up, signaling confidence just before the news. The other takes a quick exit at the bottom, helping set that floor price.
Either way, it just highlights the massive informational edge these two had over everyone else in the market.
Definitely.
And crucially, let's not forget the legal paperwork. Zage's big purchase. Totally compliant. He disclosed it properly via an SEC Form 4.
Filed on October 14th.
Which is within the required 2-business-day window. Tick the box.
And that's the point we really need to hammer home for you listening. Compliance isn't the same as immunity. Yeah, the transaction was filed legally. But the proximity, buying on the 9th.
Telling the board internally about exploring a bid on the 11th.
Filing Form 4 on the 14th.
And the bid announced on the 24th.
That sequence creates a huge perception problem. It just screams informational advantage. It looks like he knew enough to capture that 37% premium on his own $13 million bet.
So the argument really shifts, doesn't it? It moves away from a simple disclosure violation, which didn't happen, towards something more like a breach of fiduciary duty, based purely on the appearance and the timing.
Exactly. The question isn't if he told the SEC he bought the shares. The question is what he knew when he hit that buy button.
Okay, so when a deal like this gets announced, there's always the standard script, right?
Oh, yeah. It's always about long-term strategic vision and unlocking hidden value away from the glare of public markets.
And Zage definitely delivered that message in the press release, dutifully.
That's the narrative they want you to hear.
But we know, right, from digging into the filings, looking at the context, the reality seems far more urgent and way more personal.
This wasn't just some abstract strategic decision made in a vacuum. It looks like it was, in large part, driven by financial necessity.
And this is the critical detail, the piece that just changes how you have to view this entire deal.
It really is. The true driver appears to be personal financial distress, specifically stemming from the highly leveraged positions Zage and Liu held in Grindr stock.
They'd pledged nearly all their Grindr shares as collateral.
For significant personal loans.
And guess who was holding the bag? Or rather, holding the notes.
Seatown Holdings, which is a unit of Temasek, the Singapore Sovereign Wealth Fund.
So we're talking very sophisticated lenders here, and when you pledge stock as collateral like that, you're subject to strict loan-to-value ratios, LTVs.
That's the crucial mechanism. When the stock price goes down, as Grindr's did, pretty sharply, in September 2025, that LTV ratio gets breached, suddenly the loans are under-collateralized.
And when that happens?
The lender, Seatown in this case, has every right to demand more cash or more collateral. Immediately. It's a margin call, basically.
And if the borrowers, Zage and Liu, can't meet that call?
The lender seizes the collateral, they start selling the shares.
Which is exactly what Seatown did. They exercised their rights, they began seizing and selling parts of Zage and Liu's holdings.
Imagine that. It creates a severe liquidity crisis for the controlling shareholders. They're watching their equity stakes, and therefore their control over the company slowly evaporate as their own lender liquidates their shares.
There's a brutal irony there, isn't there? The guys in charge were becoming forced sellers because of their own leverage.
And that forced selling by C-Town likely pushed the stock price down even further in the open market.
Creating a vicious cycle. Price drops, LTV breaches, more forced selling, price drops further.
Which, ironically, makes the price so low that a take-private bid suddenly becomes financially feasible, maybe even necessary.
Okay, but hang on. Isn't that maybe reading too much into it? I mean, Zage is a sophisticated investor. Surely there was a strategic angle, too. How can we be so sure the personal debt was the primary driver and not just, a contributing factor?
Well, look at the timing again. The big $13 million buy comes after the stock price is cratered, likely due, at least in part, to this margin call crisis. So it reframes the whole take-private offer. It stops looking like a clean strategic move and starts looking much more like a financial rescue operation.
Designed to solve Zage and Lou's personal liquidity crunch first and foremost.
Exactly. They needed a way out. They needed to structure a deal that would let them refinance that expensive C-Town debt, consolidate their ownership again, and basically regain full control of their shares before the lender could sell off even more.
So the bid gets structured carefully. Lock in a price, $18. That seems high enough on the surface to maybe appease minority shareholders. That 51% premium sounds great in a headline.
But maybe it's also low enough to make the new debt financing package, the one they got from Fortress Investment Group, work smoothly.
So it becomes a deal potentially dictated more by the personal balance sheets of the principals rather than just the strategic needs of Grindr itself.
And here's the really profound irony that every trader needs to get. That headline-grabbing 51% premium, it's calculated against a baseline price that was artificially depressed.
The $11.96 price on October 10th.
Yeah. That price was low, arguably, because the controlling shareholders' own financial crisis was causing their lender to dump shares onto an already illiquid market.
Wow. So they, in effect, helped engineer the crisis that created the opportunistic entry point for their own rescue deal.
It's a really complex, almost beautifully executed piece of capital markets maneuvering, if you look at it that way.
Okay, let's shift gears a bit and talk legal implications, because this situation puts Zage squarely in the crosshairs of Rule 10b-5, doesn't it?
Absolutely. He's a director, he's a majority shareholder, and he's a proponent of the deal. So the big question is, when he bought those shares on October 9th, did he possess material non-public information, MNPI?
That's the multi-million-dollar question, potentially. The one the SEC is probably chewing on right now, even if they haven't said anything publicly.
Right. Rule 10b-5 prohibits trading while you're aware of MNPI. To actually prove a violation, the SEC needs to show two key things. First, the information had to be material.
Meaning, would a reasonable investor consider it important in making an investment decision?
Exactly. And second, it had to be non-public, not widely disseminated.
So when does info about a potential deal become material? We always go back to that classic Texas Gulf sulfur case test, right? The probability versus magnitude balancing act.
That's the one. How probable was the deal actually happening, and how significant would the impact be on the stock price?
Well, the magnitude part is easy here. A potential 51% premium. That's huge. Definitely material in terms of impact.
No question. So it really comes down to the probability factor. And this is where Zage looks most vulnerable.
Let's walk through the facts again. He buys on October 9th.
Right. Then, just 2 days later, October 11th, he privately informs the Grindr board of his intent to explore a going private transaction.
That 2-day gap, it really suggests the idea wasn't just some vague notion. It sounds like an active plan was already in motion.
It certainly looks that way. And what makes it seem even less like just casual exploration is the financing piece.
Ah, the debt package. Right. The proposal they eventually made on the 24th. It detailed that they'd already secured multiple highly confident commitments for a $1 billion debt facility.
From Fortress Investment Group, which, by the way, is owned by Mubadala, the Abu Dhabi Sovereign Wealth Fund. Getting highly confident letters on a billion-dollar debt package isn't something you do overnight.
No way. That involves serious due diligence, term sheet negotiations, internal credit committee approvals.
That kind of process doesn't happen between Tuesday and Thursday. It strongly indicates that concrete financeable discussions were already well underway before Zage made his big purchase on October 9th.
Which, if true, would make the information about the impending bid seem highly probable, and therefore very likely material under the law.
And you can't ignore the potential profit motive. That $4.85 million paper profit Zage stood to make just on that single October 9th purchase if the deal closes at $18. That's a massive red flag for regulators.
It just looks too perfect, too strategically timed.
But, okay, let's be fair. Zage's lawyers have some strong counter-arguments, some mitigating factors. They know exactly where to draw the line.
First up, the pattern. That consistent accumulation history. The $200 million invested over time.
Right. That paints him as a long-term believer, not just some short-term opportunist jumping on inside info.
Okay, what else?
Second, the price timing wasn't absolutely perfect. His $13.15 purchase price was actually a bit above the closing price the very next day, which was $11.96.
So they can argue he didn't perfectly nail the bottom using secret knowledge. It wasn't the absolute lowest price.
It gives them a talking point. And third, the legal status of the information at the time he bought. They'll argue the proposal was still non-binding and exploratory.
Yeah, that it wasn't a done deal yet defense.
Exactly. Lawyers will argue that until the special committee was actually formed and serious negotiations kicked off, the information wasn't sufficiently concrete or certain to legally prohibit trading by a director, especially one with a known history of buying the stock.
So where does that leave things from a regulatory perspective as of late October 2025?
Status is, no public SEC investigation has been disclosed, which is important.
That silence could mean a few things. Maybe the SEC looked at the mitigating factors, the timely Form 4 filing, and decided there wasn't a clear, winnable case for insider trading under 10b-5.
Or maybe they're just taking their time. The statute of limitations for this stuff is 5 years. This case file is definitely not closed yet. It could still surface.
Right. But while the SEC might be quiet for now, the shareholder attorneys, they're definitely not quiet.
No, the litigation risk here is very high. We've already seen press releases from multiple top-tier shareholder law firms announcing investigations. Blaismar, Fonte and Auld, Bronstein, Goertz and Grossman, DJS Law. The usual suspects are circling.
And their focus likely won't be just on technical insider trading, right?
Probably not. They'll likely shift towards breach of fiduciary duty, arguing that Zage's purchase right before the bid tainted the whole process and that the $18 offer price itself represents an unfair squeeze-out and opportunistic valuation.
So those lawsuits become the main leverage for the minority shareholders pushing the special committee to demand a better price.
Exactly. It's their best defense mechanism at this point.
Okay, to really grasp how opportunistic this $18 bid might be, we need to understand the market disconnect. Why on earth was a company like Grindr trading down at $11.90 on October 10th? What created that seemingly perfect entry point for Zage?
Yeah, the stock had taken a real beating. It was down, what, 16% in just the 3 months leading up to the proposal?
That's a significant drop.
Look, it wasn't entirely the company's fault. There were definitely broader sector headwinds blowing.
Right, the whole dating app space was struggling. Match Group, Bumble, they were all way off their pandemic highs, so Grindr wasn't alone in that.
True. And you also have the painful legacy of that 2022 SPAC merger still hanging over it.
Oh, yeah. That deal had massive, like 98% shareholder redemptions, which left a tiny public float.
And a tiny float means extreme volatility, right? It's much easier for big players or even forced selling, like we saw with Seatown, to push the price around dramatically, especially downwards.
Okay, so sector weakness, SPAC hangover. But there were internal factors too, weren't there? Things management arguably created themselves.
Definitely. They were facing significant headwinds from user dissatisfaction. You heard a lot of complaints.
About what specifically?
Aggressive monetization tactics, mostly. Really intrusive advertising, making the free version less usable, pushing subscriptions hard.
Which, when you run a niche social network built on community, alienating your core users for short-term revenue, that's a dangerous game.
Very dangerous. And then there were the safety concerns, which are always paramount for an app like Grindr. Reports of fake profiles, scams, technical glitches, all that stuff erodes user trust.
So the market was essentially pricing the stock as if the product itself was fundamentally flawed or declining in quality, even if the top-line numbers didn't show it yet, hence the low valuation multiple.
Exactly. But, and this is the key disconnect, when you flip over and look at the actual operational strength, the financials, it's a completely different story.
And this is why that $18 bid looks so opportunistic, because the market seemed to be ignoring the underlying business performance.
Let's look at the numbers the market was discounting. Q2 2025 results, right before all this blew up. Revenue was $104 million.
Which was up 27% year over year. That's strong growth.
Very strong. And the profitability, even better. It's a capital-light software platform, remember.
Right, so the margins should be good.
They were fantastic. Adjusted EBITDA hit $45 million in that single quarter. That's a 43% margin.
43%. And cash flow.
Free cash flow was $37 million in one quarter.
Okay, these are metrics that just scream high-quality growth business.
Absolutely. And the user metrics were holding up too, despite all the complaints. Average monthly active users were 14.9 million, up a solid 6%.
And importantly, paying users.
Paying users grew even faster, up 16% to 1.2 million. So people were complaining, but they were still signing up and paying.
And the company's own guidance for the full year 2025 was projecting at least 26% revenue growth.
So you have this stark contrast. Weak stock price, driven by sentiment, sector issues, and maybe some execution missteps.
Versus incredibly strong underlying financial performance and user growth.
And that disconnect perfectly explains Zage's strategic logic for wanting to take it private. He and Lou, they have backgrounds in turnarounds and deal-making. They see a business that's structurally sound.
But suffering from maybe poor execution on the user experience front, and definitely suffering from the pressure of quarterly earnings scrutiny.
Exactly. Taking it private lets them get away from that quarterly treadmill. They can focus long-term, address those monetization complaints, fix the user experience issues, invest heavily in product improvements, beef up safety protocols.
All without the public market breathing down their necks, punishing them for any temporary dip in margins or growth while they make those fixes.
It's a classic private equity playbook, isn't it? Buy it when it's undervalued due to fixable problems, fix the house without the neighborhood watching every swing of the hammer, and then unlock the value later.
It's the perfect setup, really, if you have the control and the capital to pull it off.
All right, so this brings us to the absolute crux of the matter for minority shareholders and for that special committee. Is $18 a fair price?
Yeah, this is where the rubber meets the road. You already pointed out that the headline 51% premium is kind of misleading, right? Because it's calculated off that artificially low baseline, basically a 52-week low caused by the controller's own debt drama.
Exactly. So we need to forget that $11.96 number for a minute and benchmark the $18 offer against more meaningful prices. Prices that actually reflect the company's growth potential, not its temporary crisis.
Okay, where do we start? The 52-week high seems like a reasonable place.
Good starting point. The 52-week high was $25.13, and that was hit just 4 months earlier, in July 2025.
So compared to that recent high, the $18 offer is, wow, a 28% discount.
A huge discount. Okay, what else?
How about the analysts? The people whose job it is to model this company day in, day out. Where were their price targets before this whole bid came along?
Right. Before the deal announcement, the consensus range for analyst price targets was roughly $20 to $27 per share.
With the average target sitting somewhere around $21 to $22.
Think about that. The $18 offer is a 14% to 18% discount to what the experts thought the stock was worth before any takeover premium was even factored in.
That's a pretty strong signal that the analyst community already saw the stock as significantly undervalued based on its growth and cash flow.
Definitely. And one more gut check, the IPO price.
Yes. Grindr went public via that SPAC merger back in November 2022 at $16.90 per share.
So after nearly 2 years of delivering consistent 25% plus revenue growth, expanding margins, generating tons of free cash flow,
they get an offer of $18, which is a mere 7% premium over the IPO price from 2 years ago.
that just doesn't feel like a fair reward, does it? For minority shareholders who rode out the volatility and stuck with the company through 2 years of pretty strong operational performance.
No, it feels pretty underwhelming. What about intrinsic value models, like a DCF?
Yeah, if you run a discounted cash flow analysis, which is standard practice, the picture gets even starker. Given that $37 million in free cash flow they kicked off in Q2 alone, and the capital light model,
The numbers should look good.
they do. Most standard DCF models for a high-growth, high-margin software company like Grindr would likely spit out a fair value somewhere in the range of $22 to $25 per share, maybe even higher depending on your assumptions.
So based on that intrinsic value perspective, the $18 offer looks potentially 20% to 30% undervalued.
Easily. Now, what about deal multiples? In our old PE world, we lived and died by the multiple, right?
Absolutely. Where does $18 put the valuation on an EBITDA basis?
The $18 offer values Grindr at about 16.2 times its estimated 2026 EBITDA.
Okay, 16.2x. How does that stack up?
Well, it's reasonable. For a typical private equity buyout, maybe. But is it generous? Especially for a company showing 27% revenue growth and those stellar 43% EBITDA margins in a pretty unique tech niche? Probably not.
You expect a higher multiple for that kind of growth and margin profile, wouldn't you, to reflect the scarcity value?
Arguably, yes. A takeout premium for a growth asset like this, looking at comparable deals, should probably push that multiple closer to 18x maybe even 20 guys EBITDA.
So the offer multiple itself seems maybe a bit light, too. How did the market react? The stock price after the announcement tells a story, right?
It does. The stock obviously jumped on the news, but it only went up to around $15.
$15. So that left a pretty significant gap between the market price and the $18 offer price.
A huge gap, a 17% arbitrage spread.
And that 17% spread is analytically really important, isn't it?
It's crucial. Normally in a deal like this, a high-certainty transaction involving a controlling shareholder, where regulatory risk seems manageable, initially you'd expect that arbitrage spread to tighten pretty quickly, down to maybe the 5% to 10% range.
Because the market believes the deal will happen at or very close to the announced price.
Exactly. The fact that this spread stayed so wide, at 17%, tells you the market is skeptical. Investors clearly believed that $18 was just an opening salvo.
They were betting the special committee would successfully negotiate a higher price. They were holding out for something closer to $20 or more.
That's the signal. The market itself wasn't buying the $18 sticker price. It was pricing in a bump.
Okay, so now we get into the corporate governance side of things, which is basically the last line of defense for those minority shareholders, right?
It really is. The independent special committee was formed pretty quickly on October 14th. Their stated task is to evaluate the offer and protect the interests of the non-affiliated shareholders.
And they did bring in some heavy hitters, which provides a little bit of comfort. Chad Cohen, who used to be the CFO at Zillow, he's chairing the committee.
That's a solid choice. And they retained J.P. Morgan as their financial advisor.
Blue chip investment bank. And Vincent and Elkins for legal counsel.
Also top tier.
Yeah.
So on paper, they've got the right advisors to take the process seriously and push back.
They have to.
Yeah.
But let's be real, their leverage is severely limited here, isn't it?
It absolutely is. Because Zage and Lou control over 60% of the stock, they ultimately hold the hammer.
They can approve the deal themselves eventually without needing the minority votes, as long as they meet the minimum legal standards required by Delaware law, fair dealing, and fair price.
Which brings us to what might be the most significant governance red flag in the initial proposal, the thing that was conspicuously missing.
Let me guess. Majority of the minority vote condition.
Bingo. There was no mention of requiring the deal to be approved by a majority of the shares not held by Zage and Lou's group.
And that is such a critical safeguard, isn't it?
It's everything. Typically, in these controlling shareholder transactions, a truly independent committee insists on that condition. Why? Because getting that condition included actually shifts the burden of proof if the deal gets challenged in a Delaware court.
Right. Instead of the minority shareholders having to prove the deal was unfair.
The board and the controlling shareholders have to prove it was fair. It gives the committee real teeth in negotiations.
So without that majority of the minority condition, the minority shareholders basically have very little negotiating power, and they face a much tougher legal battle if they decide to sue later on.
Exactly. Pushing for that requirement has to be job number one for the special committee. It's the key to providing genuine protection.
Now, given the urgency we discussed, potentially stemming from Zage's financial situation, the proposed timeline was really aggressive.
Super compressed. The bidders, Zage and Lou, requested a definitive response from the special committee by October 31st.
That's barely 2 weeks after the committee was even formed. It feels designed to put maximum pressure on them before they can even get their own independent valuation work done properly.
Absolutely. But the committee does have one key piece of leverage coming up very soon.
Ah, the Q3 earnings release.
Exactly. Scheduled for November 6th. If Grindr delivers another strong quarter, 25% plus revenue growth again, strong cash flow that gives the committee hard, undeniable data.
Evidence that the underlying business is accelerating, not struggling, which strengthens their argument that $18 is way too low.
It gives J.P. Morgan the ammunition they need to confidently go back and demand a materially higher price. That Q3 print is huge.
Okay, so putting it all together, the valuation gap we discussed, the governance issues, the likely strength of Q3, what's the most probable outcome here? We know $18 seems dead on arrival.
It's highly likely the special committee formally rejects the $18 offer. J.P. Morgan's fairness opinion will almost certainly come in higher, probably pointing towards the low to mid-20s.
So the committee pushes back hard.
They have to. I'd predict they push for a revised offer somewhere in the $20 to $22 range. Maybe they eventually settle around $21, give or take.
And if they reach an agreement on price?
Then we'd probably see a definitive agreement signed maybe early in 2026, with the deal targeting a closing by mid-2026, assuming no major roadblocks.
Speaking of roadblocks, we can't wrap this section without quickly touching on the regulatory elephant in the room, CFIUS.
Ah, yes, the Committee on Foreign Investment in the United States. Good point. Because while Zage and Liu are considered U.S.-affiliated investors,
The debt financing is coming from Fortress Investment Group.
which again is owned by Mubadala, Abu Dhabi's sovereign wealth fund.
And given Grin-sensitive history, remember, it was forced to divest from its previous Chinese owner due to data security concerns. Any whiff of foreign government-affiliated money is going to raise flags, isn't it?
It definitely triggers renewed CFI-US scrutiny, no doubt about it. However, the risk of CFI-US actually blocking the deal this time seems relatively low compared to the previous Chinese ownership situation,
Why is that?
because Zage and Liu are retaining control. The foreign entity, Mubadala via Fortress, is primarily providing debt financing, not taking majority equity control. That's a key difference.
So approval is probably likely.
Probably, yes. Though CFI-US might impose specific conditions related to data security, where user data is stored, how it's handled, etc. It's a manageable risk, but it definitely adds complexity and potentially some time to getting the deal finally closed. Hashtag tag outro.
Wow. Okay, so this deep dive really gives us the full picture, doesn't it? We've got the financial mechanics, the legal nuances, and even a healthy dose of personal drama driving things.
It's a perfect case study, really. A perfect illustration of how market asymmetry works in the real world.
You have a compliant insider trade, yes, but one that seems clearly precipitated by the controlling shareholders' own personal margin call crisis.
Which then allowed them to exploit a temporarily depressed stock price, a price they arguably helped depress to consolidate their control at a very opportunistic valuation. They essentially turned their personal financial problem into a potential corporate profit windfall.
And now the special committee is left with the crucial and difficult job of trying to undo that opportunistic pricing.
Their job is absolutely critical now. Fight for fair value, get a price, as we discussed, probably closer to that 2022 range to protect the minority shareholders from getting squeezed out on the cheap.
So the key takeaway for you, our listener, the finance pro, the trader out there, when you see insider purchases, especially large ones from controlling players, always ask the next question.
What does this person actually control? What immediate strategic decisions are they empowered to make? Potentially very quickly.
In this unique Grindr situation, that Form 4 filing felt less like a routine disclosure.
And more like a strategic flare gun, signaling that the buyer possessed a level of certainty about the future that the rest of the market completely lacked.
Which brings us right to our final provocative thought for you to chew on today.
When a director, who is also the primary architect behind a major corporate event like a takeover, files that legally required SEC Form 4 disclosing a massive stock purchase just days before that event is internally set in motion, does that timely filing truly eliminate the informational advantage?
Or does that compliance, that legal shield, simply allow the insider to capture the arbitrage that was created precisely because of their position of power and their unique knowledge? The control they wield almost makes the information self-fulfilling, doesn't it? It really makes you think, what level of information should even be considered material and non-public when the person doing the trading is the very person pulling the strategic strings?
That's the fundamental question that sits right at the heart of modern corporate governance and insider trading debates.
Definitely something to ponder. We will absolutely keep tracking the special committee's response and especially that critical Q3 earnings release coming up.
For more granular details on Zage's filings, loose sale, and all the other insider trades we track, make sure you check out insidersignal.ai.
Until next time, stay sharp out there.
And keep those Form 4s open.